bring the meeting to order. For the roll call, Robert Stevenson, present. Rita Russell,
Present.
Beverly Coleman,
Present.
Jim Woodward. Here, Shelley Warwick,
Here.
George Gregory,
Here.
Stephen Knoll, here. Keith Lockwood, absent. Richard Petow.
He's on vacation. He's out as well.
And staff, Kevin Engels. Here. Tim Dodd. Here. John Woodsky. Here. And Monica.
Here.
Thank God.
Amen.
Approval of the minutes. Does anybody have any addition to last meeting? I saw no problems. I looked at them and I would entertain a motion that we approve them as submitted, unless there are any additions or.
Can I just ask a question?
Yeah.
So is Director Engels, member as well as staff liaison?
No, he is
I'm no
not.
longer a member of the board.
You're no longer, but you were the last time?
I was.
Yeah,
Okay,
yes, when council approved that, that was one of the adjustments that were made. And I see Keith or Kevin flying big crocodile tears.
I'll still be here with you.
yeah.
He's not gonna skip anything. Right,
And that was at the request of the CAO, right?
okay. Do I have a motion to approve?
Vote to approve.
Second?
Second.
Hearing no, no's, I will submit them as approved. And let's go to new business now. How are we going to conduct the swearing in? Monica?
I suggest those present, we all read along, agree and sign. That's how we've done it in the past.
Okay, I will read mine and submit my name. I, Robert Stevenson. I do solemnly swear or affirm that I will support the Constitution of the United States, the Constitution of the State of Colorado, the Charter and ordinances of the City of Englewood, and that I will, to the best of my ability, faithfully perform the duties of office as a regular member of the Englewood Employee Pension Plan Board, for my continuance therein. Do we all swear?
Yes.
I swear. And if you will sign, we will pass them back to Monica and get them effective.
And the checklist attached also needs to be reviewed and signed on the back.
Oh, on the back.
Mhm.
There's this one here.
Yes.
Yeah.
Thank you. Yeah.
Oh, there.
Thank you. Fantastic. Thank you.
Very good. Do we have any public comment? I don't think we have anybody here. Outside of the board and the other participants, so we will move on to the GRS report that we've all been anxiously waiting.
Well, thank you. As you can see today, we have brought your whole team. So I'll give everyone a second to introduce ourselves. For those of you who haven't met us before, I'm Christy Kiesel. I'm one of the actuaries on your plan with GRS. I've actually been working on your plan for about 10 years now. And this is my favorite time of year when we get to bring you some results.
I'm Alex. I'm an analyst. Been working on this plan for 3 years. So yeah, excited to be here.
Paul Wood with GRS, Senior Consultant Actuary and also the team leader. So I'm responsible for the operations of our team in Denver. And then half of our team is in Dallas, and I've been working on this plan for, it'll almost be 10 years here soon. It'll be 10 years in Denver in November. So great to be here today. Thank you.
Yeah, and with that, that's also a big depth of knowledge. We've all been working on your plan for a long time. So if there's anything, and I will say specifically, since you guys have combined boards, we are specifically talking about the non-emergency employees retirement plan that we all specifically work on. So if there's anything we don't cover today, also feel free to ask us questions and we will get back to you with that. So with that, we're going to hop right in. Today, we are actually going to start out with a little bit of actuarial 101, just since we do have some new faces in the room. We thought it would be really helpful to start out by giving you an idea of why we're here and what the numbers that we're bringing to you mean today. So with the respect to everyone's time, we'll try to get through it a little bit quickly, but also try to make sure you have enough detail to understand what we're going to be covering. So to start with our actuarial evaluation basics, we really want to start out here on slide 4 is just a quick overview of why we are presenting you with this actuarial evaluation and why this information is important to you. And so one of the primary metrics that are going to come out of your actuarial evaluation is determining that actuarial determined contribution, which is going to be your recommended employer contribution rate. So for the NERP plan specifically, you do contribute on that number that we produce. So that is something that comes out of your actuarial report that is going to tell the city exactly how much contributions are going to be going into the plan in that following year. In order to develop those numbers, we are going to be looking at your actuarial liabilities and your assets. We are specifically looking at them at one point in time for the actuarial evaluation process. We are looking at your liabilities and your assets as of 12/31 or 1/1. Sometimes we'll say them interchangeably. And then we're going to look at the funded status. So we're going to look at those liabilities and we're going to look at the assets and we're going to see how well funded the plan is as of today. We are going to dig further into the definitions on all of those pieces in just a moment. But these are just the primary things that are coming out of your actuarial evaluation. And most importantly, maybe, is that we're also going to look over how the plan is changing over time. And that's really just going to see what kind of trends are coming out of the plan. And are we seeing things such as an improvement in your funded status? Is your contribution rate continuously increasing? Is it about stable? Is it decreasing? And seeing how that's developing over time. And we're going to look at that in an actuarial evaluation report. Which brings us to slide. And this is just a basic funding equation. And this is going to apply to everyone in this room. So this first part of the presentation, this really isn't just the NERP. If you're involved in your retirement plan, this funding equation applies. This is at the core of everything that we're discussing. And it's going to boil down to the main concept that we want our money in to be equal to our money out. And most importantly, a retirement plan is a long-term plan. So we're not necessarily saying money in today needs to equal money out tomorrow or today as well. But over the long term of the plan, we're saying everything that goes into the plan needs to make sure that we are able to pay every single benefit down to the last penny on the very last day of the plan. And so in order to look at that, we have these 4 main components. The first 2 on our so-called money in side are going to be your contributions. And as I mentioned before, that's going to be based on your funding policy. For the NERP plan, you fund based on your actuarial determined contribution rate. Then you also have your investment income. And so that's what your brilliant investment advisors that are at the table today are here to make sure that that part of the equation is doing really well and performing strongly. And then on our other side of the equation, we have the benefits, and those are gonna be based on your plan design. So that is where we say exactly what the members are going to be owed in retirement. And then additionally, you're going to have your expenses component. So it's typically primarily going to be made up of those administrative expenses and what's going into running the plan. When we look at the benefits and expenses side of the equation, that's relatively fixed, so to speak, in terms of the fact that you can't really adjust it. That is set by your plan design. It's set what you're going to owe people in their retirement, and therefore where you can really make adjustments and where you need to be able to balance this equation and make sure that our money in is equal to our money out is either going to come from those contributions or from the investment income. In the case of the NERP plan, since you contribute based on that actual determined contribution, that rate is going to fluctuate from year to year to an extent to react to any of the actual experience of the plan as it comes about, so that you continue to contribute, whether or not you have some gains or losses, then you'll see that get incorporated into that contribution rate to make sure that you're still funding for those benefits based on the actual experience. And that takes a little bit of pressure off of the investment income. However, it is still a very, very key component so that that contribution rate doesn't have to increase too highly, that we see strong investment returns on that. On to our next page, just a quick fun little diagram of what's going into your actuarial valuation report. So what are those inputs that we're taking and putting into this? The very first thing is going to be your census data. So we do use the actual data for the members in the plan, and that is something we received from Monica. And that is going to include all of your active member data, your retired members, your vested members, what kind of salaries they're earning over the year, what kind of contributions were going into the plan, things like that. Then we also are going to get your asset data. That's going to be as of one point in time. So that is going to be your current value of the assets you have in the plan. And then we are going to do a little bit of an actuarial value of assets. That is actually going to be going into the actual valuation. Next, you have your benefit provisions. So that's going to be specific to your plan. As we discussed, that's going to be things like at what age people are eligible for retirement, at what age they are, or what service level they're vesting, what is the multiplier rate that is going into their benefit, is your final average compensation based on a 5-year average, 3-year average, things like that. That's going to be your benefit provisions. Then we have our assumptions, and these are really key also to that last equation we talked about, because all of your experience or all of your benefits and what the true cost of your plan is going to be borne out in actual experience, but we need to make assumptions for what we think that experience might be, and we need those to be reasonable assumptions that are going to model what we believe those true costs of your plan are going to be, and reviewing those assumptions and making sure that they are relevant to the plan and continuing to correctly approximate. We will never get it exactly right, but in order to make sure that you're properly funding the plan in order to pay all of those benefits. The last date, we're going to enter some assumptions for when we believe people are going to retire, begin collecting benefits, that sort of thing. Next, your two pieces to the side here. We have our actuarial cost method and our funding policy, and those are going to be the things that are really determining how you're funding the plan and how we're determining those costs that go into the plan. So that's going to be determining how we calculate your actual determined contribution rate, and how we determine those costs to the plan, and then additionally how you choose to fund the plan. So in this case, the plan is funded on our actual determined contribution rate. We have a layered amortization base, which means year over year, we're going to take part of your amortization and we're going to apply a different base to the gains or losses within that year Again, we'll get a little bit deeper into that, but those are really those cost methods of how we're going to go about funding the plan that's determined typically by the board and by you all. And then I am actually going to pass it over to Paul to get to the alluding to, I'm saying words, and we're going to now describe exactly what some of those words mean.
What?
So Christie just covered those inputs to the valuation. So what are the outputs? And so we have the list of 7 different metrics that come out of this. And if you ever spend any time on an actuary, we have an acronym for each and every one of these, but we'll stay away from that today. But we'll talk about present value, future benefits, normal cost, accrued liability, actuarial value of assets, unfunded accrued liability, funded ratio, and the actuarially determined contribution. Let's move to slide 8. And we think that one of the best ways that we can have boards like yours understand what all that terminology means and how it plays into the valuation, just walking through a really simple example. And so our simple example is going to assume that there's no investment earning whatsoever. So investment earnings, we just muddy things up, make the math difficult to do in our heads. We're going to assume that the member only works until retirement and then receives a set number of payments, and that any of these other probabilities or decrements that could potentially happen, we're just going to ignore them. We're going to assume that the member's hired, works till retirement, leaves at retirement age, and then starts collecting a benefit. And so on slide 9, I want everyone to close their eyes and imagine this newly hired City of Inglewood worker was hired at age 30. They're now age 40, so they're 10 years into their career. They're going to work until age 60, so they still have 20 years ahead of them in their career, so 30 years overall. And then at the time that they reach that retirement, they've accrued a benefit that's roughly equal to $30,000 per year. That's going to be paid out beginning at age 60, all the way through their death at age 80. And so we have that sort of scenario set up in our mind. And we move to slide 10. You can start talking about some of this terminology. First, we want to think about the present value of benefits. So this is the value in today's dollars of whatever benefits have been promised to this particular member. And so in this case, we know that we have that $30,000 benefit that's going to be payable at age 60. They're going to collect it for 20 years. So 20 times 30,000, the value of that benefit is $600,000. Since we were ignoring interest, the present value of that is also $600,000. And so we think about in your evaluation, you're going to look at there's going to be a big number. It's one of the bigger numbers in the report, the present value of benefits. And it's this calculation performed for each and every individual in your plan. We calculate what we expect the benefit to be, how long that member is going to collect it, discount it back to today's dollars, and give you that particular metric to look at. So how do we accrue enough assets to match that present value of benefits? We know that we got to have some assets on hand at some point. And so what's the best way of doing that? Well, this is where the actuarial cost method comes into play. And we first have to calculate what we call a normal cost. And we can think of this as the cost of accruing 1 year's worth of benefits. So the value of our benefit last year was $100, and the value this year is $200. The normal cost over that last year is the cost of that accrual, or an additional $100. And so when we think about how this member is going to accrue that $600,000 benefit over their career, we know that they're going to work 30 years. And so we pretty much need to accrue $20,000 each and every year to make sure that we have that $600,000, $20,000. So we have $600,000 on hand at the time that that member retires. And so that $20,000 amount, again, is the normal cost. That's the accrual that we need to have each year to accumulate to whatever that present value of benefits is equal to. So now we take that present value of benefits and we split it up into a couple of pieces. And you know that, for our active member, and for this member in particular, they're only 10 years into a 30-year career. And so we don't need to have that entire $600,000 on hand today. And so what we need to calculate is how much really should we have on hand today? And that's what's called the accrued liability. And so if you're 10 years into your career, remember our normal cost, ignoring interest and all that, is $20,000 a year. Our accrued liability, what we should have put away at this point, is $200,000. So 10 years times your normal cost. And you can see how that actual accrued liability down there starts to grow. So 5 years into your career, 100,000, 10 years, 200,000, 20 years, 300,000. Then we get to our 20 years, 400,000. When we get to our 30-year career, we should have 600,000. We've fully accrued the entire benefit. So the actual cost method is what's going to help us allocate between the total present value of benefits versus what's already been accrued to this day. Moving on to slide 13, I would start talking about a little bit about some of these metrics that we're going to use to help determine how much money we may need to put away for this particular member. So first we want to think about, well, what is our unfunded accrued liability? So how does our accrued amount compare to what we actually have on hand? And we know in that last example, we should have $200,000 on hand. Well, if we only had $100,000 on hand, that means that we have a $100,000 unfunded accrued liability. And then we also look at the funded ratio, which is that ratio of our assets to our liabilities. So again, if we only had 100,000, we know we needed 200,000, we're 50% funded. And so we can look at those in your valuation and say, okay, well, what kind of progress do we need to get up to 100% funded to make sure that we have that money put away at the time that our members retire, and that we have enough on hand to cover all those benefit payments. So in slide 14, this is where we lead into the discussion of how do we fund that accrued liability? How do we make up for any difference between the asset value and that accrued liability? And that's where the actuarially determined contribution comes into play. And it's made up of three components. Again, the first piece is we need to keep up with accruals, right? So every year we know this member is going to accrue $20,000 in benefits. And so we want to keep up with that. So that's the very first piece. We're going to put $20,000 away for this member as the normal cost. And I mentioned if we have any shortfall between that asset and the liability figure, we need to have a plan in place to pay that off. And that's where the amortization of the unfunded accrued liability comes into play. And so we've come up with a schedule to say, okay, the city or, we're funding for this particular person. What additional contributions do we need in addition to the normal cost to eventually pay down that liability so that we have that full $600,000 accrued at the time this member reaches age 60. And so you can think of this a lot like a mortgage payment. We take out a mortgage on our house, we make a level dollar payment for 30 years. After 30 years, the house is yours, with the exception of property taxes, but the house is all yours, you're free, clear, and you can move on. And so that's what we're trying to do here. We're trying to pay off that mortgage and to make sure that we have all that money on hand to cover the liabilities at the time of retirement. Then we know that there's some ongoing expenses. Again, another piece of this would be to cover those administrative expenses. Christy, talked about my very, very favorite equation, C plus I equals B plus C. That expense piece is an important piece. And if we ignore that, then again, you either have to make additional contributions or you have to have investment earnings. So it's important that we include an expense portion in the contribution calculation. So put those three pieces together and we have the full actuarially determined contribution. And, I think I've got two more slides, but maybe just one point on the actuarially determined contribution. You do want to give hats off to the city for contributing based upon that amount. There's a lot of communities in this area that are not contributing on an actuarially determined basis, and they're just contributing a fixed percent. Come hell or high water, we're going to make a 12% contribution to the plan, and it doesn't change based upon experience. So the fact that the city has decided we're going to take that little bit of risk and have a variable contribution, but that variable contribution is always going to be putting us back on track to pay off any unfunded accrued liabilities. So that's a positive thing for your plan in particular. And again, hats off to the city for stepping up and making that contribution, having it adjust when you need the money. My last two slides, Christy kind of alluded to this. We talk a lot about, and this is for getting away from that other example, but just what are we doing with the assets? You're looking at a report, you're going to see a market value of assets, you're going to see actuarial value of assets. But what does this all mean? And so we know that, in the short term, there's going to be a lot of volatility in that market value of assets. So there's going to be good years, there's going to be bad years. So we were constantly making our decisions based upon a really good year. Our contribution rate would come down and we'd all celebrate and everyone would be really happy. But then what happens the next year if we have a bad year? That contribution rate is going to spike again. And now we're going to be wondering, where do we find, the room in the budget to handle this increase in the contribution rate? And so in order to address that, I think that's on the next slide, we typically use what's called an actuarial value of assets. This is where we ignore, in a sense, those short-term fluctuations as highs and lows. and we implement what's called an actuarial value of assets smoothing procedure. So we're gonna look at the gains and losses each and every year, and we're not gonna recognize the full gain or loss in this year, we're gonna recognize just 20% of it. The following year, recognize another 20% of it. And what this is ultimately going to do is it's going to create an asset value that we can use to make decisions upon that filters out all that noise, that volatility, that variability, and shows us what is the true trend of our asset figures. You know, is our assets, are they really trending downward? Is it trending upward? Is it flat? And then we can look at that asset value and say, let's make a decision on this and not overreact or underreact based upon short-term volatility. Again, Christy mentioned earlier, this is a long-term proposition. You know, I'm sure there's someone who's been hired within the last couple of weeks who may be working here with the city for the next 30 years, and then collect another 30 years worth of benefits. So you make a 60-year commitment to somebody who was just hired. And so again, we want to make good decisions on good data.
Which I will say, I meant to include this graph, but just a visual representation, because we don't have it. I feel this is gonna be a little bit extreme. But, you know, what we're talking here is we have a market value of assets that's gonna go up, down, up, down, up, down, versus what we're trying to do with a smooth value is to get you on the same trend for our assets while it remains more smooth so that you can make decisions based on that. I thought I had included a slide with a graph that shows that, because I do think the visual representation does make a little more sense why we do treat it that way. So I figured I'd throw that out there before we move on.
That's great. So any questions on the 101 or just some of those descriptions? Did that explanation make sense?
I know we went through it a little quickly, but we did want to give you all just kind of a basis, and hopefully to give some knowledge, also, keep those of you that are part of the old tire board with us for a little while before we get into the part that doesn't have as much to do with you. Which we are going to pass off to Alex here to get us into some of those valuation comments.
Much. So yeah, those valuation highlights. The first thing, the active population, which is a count of 59, didn't actually change from last year, which is good. And I'll get into that a little bit later. The actuarially determined contribution, the ADC, which we had defined earlier, had decreased compared to last year. Last year was 26.3%, and now it's just under 23%. But remember, the employees contribute a constant 3% of pay. So it's actually the city's portion as a percent of pay that went down. It went from 23.3% of pay down to 19.8%. And in dollar terms, that's a little over $100,000 as their city's portion decreased, or 11.8%. And again, like we mentioned before, when we talk about the investment return, it's always as a snapshot in time, the very beginning of the year, January 1st, 2025. So as of that time, because I know the markets have changed since then, 10.3% was the return that we got for the year, which is great, especially compared to the assumption that we have of 6%. And you can see here right below that, the 7% on, that's the actuarial value of assets. You can see it didn't spike as high because we smoothed that value. And so overall, again, based on the AVA, the actuarial value of assets, funded ratio increased from 86% about to just under 89%. So going more in detail on the member data on the next page. This is again a snapshot from what did the demographic census data look like as a snapshot at the beginning of 2025 versus the snapshot from last year. So there was one age retirement in 2024. 6 members had terminated, 2 elected to drop retirement, and there were 8 new members that were hired. And overall, that was almost a 2% increase in payroll. And like I had mentioned before about the active population not changing, it was 59 this year and last year. I bring that up because back in 2009, the active population was 159. There had been a trend of it decreasing over the years, so it's good to see that stabilize this year. But overall, because of the new hires, the average age in service for the plan did decrease. Going on to the next page. where we show the change in the market value of assets. You can see, 2024 on the left and 2023 on the right. The total contributions did decrease a little bit. And, we have 0 expenses reported for 2024. If you compare the investment income, you can see it was very high in 2023. It was great in 2024, of course, but it was a little bit lower. You can see how that resulted in 12.5% return at the bottom of 2023 there, compared to our 10.3% this year. With that, I'll pass on to Christie.
Yes, so that is our market value of assets, which then brings us to that actuarial value of assets. So that's actually what we are going to be using to determine things such as your actuarial determined contribution rate. That's tends to be the funded ratio that we're going to focus on. So with that, we do recognize your gains and losses over a 5-year period. So that means we're going to recognize 20% of either the gain or the loss. So that is going to be the amount that you earn either over 6% or under 6%. We're going to only recognize some of that in each year. So our return on our actuarial value of assets for the year was about 7%. So as Alex mentioned before, that's just a little bit lower than we're seeing with that 12.5% and that 10.3%. And the reason that's still low is because we're still recognizing some of those losses from back in 2020, and we're going to see some of those fall off here soon. And so we do see that we still had a gain though on our actuarial value of assets because that 7% is still above our 6% expectation. So here you can just see the difference between our actuarial value of assets and our market value of assets is going to be those deferred gains in this case, because overall we do still have more years of gains that we're deferring versus those losses. And this just means that we're going to see some decrease in the pressure on that contribution rate in the future. And by in the future, mostly over those next 5 years where we are going to be recognizing those gains over time. Especially as we see that loss base drop off here very soon. So our liabilities. So this is that amount, right, that Paul told us, this is really our target asset. This is the amount of assets we want in the bank today, because this is the amount of liabilities that have been accrued by your current plan members. So we did see a bit of a liability decrease. This is going to be due to several factors. We did see a few more retiree deaths in the system. We didn't see a lot of additional. If we went back to that membership exhibit, we'd actually see that the membership counts stayed exactly the same. So we also didn't see a lot of movement into other positions. And then we also have those newer members who have a lower accrued liability to date. So as Paul mentioned, that accrued liability, it's accruing each year that you're receiving service in the plan. So those people who have entered the plan with lower service, they will have accrued a lower liability amount. So this accrual was less than expected, which means that it's going to be a gain for the plan. And just down below, we have a comparison. So you can see last year we had a loss that was primarily due to large salary increases above what we expected, versus this year you can see we had a small gain because the salaries were about on track with what we expected them to be from year to year. And so these are things that you can see in that gain loss, where we're not going to be exact every year, but our hope is to not have any strong bias where we're seeing consistent large gains or losses in any one category year over year, but approximately balancing. So our overall result was a gain, and you can see it's primarily from that retiree mortality, where we did lose some people to pay benefits to, resulted in a gain for the plan. So a little extra on that gains and loss. So on that last page, that was just your gains and losses based on the liability for the year. And so that's the number that you're gonna see again here, that demographic liability gain. That's gonna be that same one we saw on that last page. We additionally saw that investment return gain on the actuarial value of assets. So that's that 7% over the 6% expectation, which resulted in just under 900,000 total gains on the year for the plan. So how we use those gains is how we're going to put them into our actuarial determined contribution rate. This is all broken out a little bit farther in your valuation report, but the overall here, we're seeing the I'm going to skip to our amortization payment to just stay on those gains portion. So that amortization payment, that is where we are paying down that unfunded liability that we've talked about. In your case, you have a layered amortization base. So each year, the new gains or losses in the system are going to be amortized over a 10-year closed period. And we keep building upon that base as we go. And so this payment here is where we're adding in those additional gains, so to speak, on the system. And you can see that in our current percentage of pay on that amortization came down from about 17% to just under 14%. But that does make up the largest portion of your actuarial determined contribution. And then I'm going to bring us back to the top line now. And that's going to be your normal cost component. That is the component that Paul described as the cost of each of the members accruing those benefits for 1 year. So that's the cost that we want to be continuously putting into the system to make sure that we are funding the benefits that are being accrued every year. And then we just come to the final city determined contribution, and that's actually going to be your contribution rate. So right now, the city is contributing 23.3% in the year of 2025 from those 1/1/2024 results. So this 1/1/2025 result of 19.8% is going to be the city's contribution in the fiscal year 2026. And that is going to be a contribution based on your payroll amount. And then just to wrap up our determined contribution rate, as we mentioned, one of the primary purposes of the actuarial valuation is to also monitor how things are changing over time, where the plan has been. And this graph here is showing us where we've seen that variable contribution rate. So that's where that equation, our C plus I equals B plus E, this contribution rate, as we talked about, you have a bit of a variable contribution rate because those contributions are going to make up for any times where we are seeing larger losses, whether it be that the investment returns are not as high as we expected, or our actual experience is not matching up with our expectations. This contribution rate is going to change in order to make sure that those benefits being paid, or in order to make sure that we're still able to pay for those benefits that are based on the actual experience of the plan. So we can see over the last 4 years, we've been relatively flat with a little bit of a dip this year, which really brings me to my last slide. And this is just something to look forward to, but I think I also want to pose some consideration for you all. So our next steps are going to be bringing to you not just where the plan has been, but where is the plan going. So we're going to be bringing some projection results, which is going to say where we expect things like our funded ratio and our actual determined contribution rate, how we expect those to look over the next few years. Because of how we've talked about, the actuarial value of assets has some gains currently being recognized. So we're expecting a downward pressure on that actual determined contribution rate, which is to say on this other, we are expecting it to continue to decrease a little bit over that time where we are recognizing those asset gains. However, we do still have some unfunded liability bases, and the way the layering is worked into the plan, and you'll see this when we bring the projections, we do in the next 8 years expect for the contribution rate to go back up to about 25% from where it currently is. So if there'd be interest from the plan of having something a little more stable instead of that variable up and down. If there is any input on the types of projections you'd like to see, and if you would have any other interest in not seeing that decrease step by step over the next 5 or so years to then go back to an increased contribution rate, it's something we can consider when we're looking at that projection analysis. That was all we got. Paul, did you have anything to add?
Just on slide 25, I think this is a pretty cool visual. When we think long term, I mean, what is the cost of our plan going to be in the long term? And so we've got those two bars separated there. You've got the bottom piece is the normal cost, but the cost of accruing the benefits. And then the top piece is the amortization. So that by virtue of us not being 100% funded, we have to make that additional dark green contribution amount. When we reach 100% funded, that's going to go away. And so we'll be left with just that 9.2% normal cost amount. So what this is telling us is that on the horizon here, not too long from now, I certainly hope to be alive then, but this 13.6, this additional amount is probably going to drop away, and there's going to be a significant amount of money that could be freed up in the budget to do many things with. And so we just kind of have to keep our eye on the prize and keep moving towards paying off that unfunded accrued liability, getting to 100%, and then getting that contribution rate down to, the 9 or 10% level. That will go a long way to help the city and to really shore up this plan to make it sustainable for the long run. And like Christy mentioned too, there's we could look at this and, bring you some strategies on dealing with some of this contribution rate volatility. One of I worked with a big plan up in Wyoming, and they moved to this actuarially determined contribution amount, kind of like you, but they have some provisions in there where their rate's not allowed to drop unless they're over 99% funded. So it's sort of like this asymmetric relationship between, if you got a really good year, the rate's not going to come down, but if you have a bad year, the rate could go up. And so that's something that's going to help them achieve their funding a little bit faster. And so there's a ton of ideas that we could bring if it was any interest to you as a board to manage some of that volatility that we're going to see over the next 10 years.
Do you foresee us being completely funded within, say, 7 to 10 years?
It'll be close. It's probably closer to, if you recall, I think it was in 2022, we re-amortized the unfunded accrued liability over a 15-year period. And so there's still about 11 years, I think, left. Is that right? So 11 years on that big base. So, it's, unless we have some overperformance, we just stick to the plan and we get to 100% funded. That funding policy, I like to think of it as like the GPS if you're driving in your car. You plug in an address, you make a wrong turn, it's going to start yelling at you, turn around, get back on, rerouting, and it's going to reroute you back to where you wanted to go. And your funding policy is going to do that, and it's going to accelerate if we need to, it's going to slow down if we need to, but ultimately it's going to put us on track to pay off that unfunded liability.
So the expectation is about 10 years. And I can pass this to anyone else who would like to see it. And then it was in your board packet. That's going to be on page 4 of the report, where it's showing that amortization of the unfunded accrued liability. And it was that 2020 is when we re-amortized, and that first base was actually 15 years closed, just since it was larger. And so that's down to 10 years this year. And then subsequently, this year's additional gains are over the next 10 years, and so on and so forth, down from the other years. So it is about 10 years. But before that happens, due to that initial base dropping off, needing to be funded in those last few years there, that is where we're expecting there to be some increases to the contribution rate to make those last couple of payments on that initial large unfunded base.
Remember, I mean, this was the plan. So if we just stick to the plan, then we'll be in good shape. So.
And as Paul said, the fact that the city and the board have been able to make this funding policy where you are contributing that for determined contribution rate. That's why you have also stayed on that course and stayed on track to that funding in 10 years.
Another question? Thank you. Okay, now for Innovest.
Thank you. That was a great overview. Very informational. I'm gonna kick us off. My name is Wendy Dominguez. I'm the president and co-founder of Innovest, and I've actually been working on this plan for 20 years. So it's great to meet new committee members, but to have been a part of the history of this plan over time. I'll take you to page 3. We like to sponsor educational opportunities. I know some newer committee members might benefit from this. We host an event at the end of August called the Part of Public Planning Coalition Annual Conference. It's great. It's focused probably a little bit more on defined contribution plans and defined benefit plans, but it's still a great opportunity to learn about fiduciary responsibility and investment strategies and things like that. So I would welcome you to consider attending that as well. For the newer members of the committee, pages 4, 5, and 6 kind of represent the running history of major changes made in the plan over time. It's on the take you to page 6 just to remind you of a couple of changes we made. At the beginning of the year, we anticipated probably not as much volatility as we've seen in April, but we anticipated that there would be more volatility. And so in order to battle that, we wanted to further diversify the portfolio. So we spent a lot of time thinking about what could we add to the portfolio to drive that volatility lower and to get us into different areas. And so we came up with the idea of adding to other real assets or infrastructure, timberland, toll roads, liquid natural gas exporters. I mean, just a whole gamut of other things that aren't necessarily related to equity markets, but we thought had a nice runway going forward, as well as higher diversification benefits. So we did add that in the first quarter, as well as make a replacement in one of the hedge fund investments in the plan. Page 7, now this performance is as of 3/31, and Stephen was going to get into more performance data in just a minute. But as of March, you might be surprised to see that we were actually positive in this portfolio. There were probably a couple time periods in April that we were negative, but I can assure you that as of today, we've seen some pretty big rallying in the markets. You're probably up a couple percent, I would say, year to date. So far this year. So portfolio has held up incredibly well in a very tumultuous time, and I'll talk a little bit more about that. But cumulative performance going back to 2007 is 257%. So that's always nice. And if you look at how that translates to annualized performance, that's a 7.5% there top. If we turn to page 8, this is looking at dollars. Way back when we started about 28 million in plan assets, and now we're 41, and that is including $20 million of payments made to your employees. So markets have added about 34 million in assets, and this picture is another way I think of looking at some of the actuarial things that they're showing you is that the blue line represents the net amount invested. So that's been going down over time. But yet the green mountains represent the ending market value. So that difference is showing the value of being invested. So it's I think a great picture for you all. Page 9, talk a little bit about the markets. It has been incredibly volatile, especially for U.S. equity markets. This is as of March 31st. U.S. large cap stocks were off 4.3%. It got all the way down to maybe minus 9 or 10% in April, and then has rebounded and is now down a couple percentage points year to date. Small cap stocks really took it on the chin. They were down 10% year to date as of March. Probably went down closer to 15 or so. and have bounced back a little bit, but still in negative territory. What might be surprising, especially because of all the tariff talks, is that international stocks in emerging markets have held up really well. In fact, international as of the end of the quarter was up 7, and since that time have increased those market gains. Bonds held up well, as did all of the diversifiers that we added to the portfolio. So the goal of all of what we're trying to do is create a smoother ride, kind of like that smoothing that we were talking about just a minute ago, and that's really the goal of what we're trying to do. On page 10, just a couple of things on the economic side. I think if you were thinking about, there's a lot of categories listed here, but if you're thinking about kind of a win-loss column, some of the things on the win side are inflation. Inflation numbers have come in below expectations, which is a great tailwind going forward for markets. Although it is still painful, if we look at the cumulative effects of inflation, especially on consumers, it's been pretty staggering. But right now, at this point in time, inflation feels a lot better. Corporate profits are also probably on that win side. Corporate profits are up about 8% as of the end of the first quarter. I would say that the loss side is in that consumer sentiment. Consumers, when you ask them how they feel uneasy. They feel like there's a lot of uncertainty, and as a result, their consumer sentiment numbers have plunged. Both consumers as well as businesses. Now, consumers drive 2/3 of our economic growth, so how consumers spend is really going to drive how our economy goes. So it'll be interesting to see whether they just say they feel bad but continue to spend, or have their spending follow their feelings. So far, spending has been relatively robust. I'm going to take you to page 13. We talked a lot about sentiment, and this page 13 shows that in a couple of graphs. Business sentiment shows the decline there on the upper chart. Consumer confidence also showing the decline. The chart on the left shows the headline policy uncertainty index, and you can see it completely spike in 2025 based on some of the tariff discussions and other geopolitical issues. I think what's interesting is not only the degree of the spike, but the last time we've seen a spike that hard or large was during COVID. So the uncertainty and the volatility of the markets are something that we haven't seen for quite some time in a very volatile market environment. I'll take you to page 16 as a way to end with some hope before I turn it over to Stephen. This chart shows when we've seen sharp drawdowns, what happens in subsequent 1 or 3 or 5 year periods. A couple things to draw from this page is that we've seen 2 of the biggest declines, 3-day declines happen in April of 2025. So that's that kind of puts it into context. But I think the more hopeful picture is on the right. When we have seen big 3-day declines, the next 1, 3, 5 year returns for the S&P 500 have been all positive in every single case. Some cases only 1%, which is 1987 there at the bottom. But 5-year performance, you can kind of scan that column, and there's some very significant 5-year performance numbers. So again, who knows if this will hold true this time? But again, I think and every time since then it has. So we'll be cautiously optimistic. So with that, I'm going to turn it over to Stephen, and he can hit some highlights of your investments.
Great. Well, great to see everybody. Let's go to page 21. And just as again, a refresher, Wendy mentioned that first meeting we had of the year was really to look at the asset allocation, see if there's any places where we can make some tweaks, where we think, again, can help protect the portfolio, help achieve those long-term returns that we're looking for in a prudent manner. And so, again, just for some of the newer folks, that kind of top section there highlights, again, some of the investment objectives. So again, this is a longer time horizon, of course. We have, the actuarial return expectation of 6%. We also show, downside risk within the portfolio. So, to earn these returns that we're trying to achieve over time, there is risk. In a really bad market, we could see a pullback of, 15% or more in a 12-month period. Page 21 below that just kind of highlights the full breakdown of the portfolio. So you can see on the left-hand side in kind of the dark bold is the asset class. So you can see again, within large cap stocks in the US, 3 different managers below that, and then below that, all the various kind of asset classes and parts of the world, parts of the market that the city is invested in. And then as you move to the right-hand side of this chart, you see our target allocation. That's the second column from the right. So again, that is our long-term target. When we think of, how much exposure do we want in each of these pieces? And then you see just to the left of that, the actual allocation as of the end of the quarter. So again, we generally want to be pretty tight in terms of actual versus target. And you can see for the most part, plus or minus, really a percent or even less in a lot of the cases. And then flipping to page 22 just kind of rounds out the portfolio. We'll touch a little bit more about these in the table of returns, but really all these kind of investments on page 22 kind of fit the bucket that we would call alternatives or diversifiers. So these are kind of investments outside of just publicly traded stocks and public bonds. These are investments that we all think serve a particular purpose in the portfolio, whether it's maybe a hedge against unexpected inflation, whether it's again long-term growth, whatever it may be. These all serve a unique role and help manage that volatility, as Wendy mentioned, and have been really additive to the portfolio over longer periods of time. Page 23, this is our manager scorecard. This is kind of a snapshot of our thoughts around the portfolio and the specific investment strategies. So you can see all those same strategies that were listed in the 2 pages above on the left-hand side. So starting at the top, all the way to Cliffwater Corporate Lending at the bottom. And then you can see the criteria that we're reviewing along the top. So we're looking at the organization, culture, the actual personnel, the people managing the assets, philosophy and process, style consistency, asset-based performance, and of course, expenses. And so for this quarter, again, a couple of updates I wanted to talk about. On the far left-hand side, under organization, all the way to the bottom, you see a new minor concern. That's a downgrade. That is a downgrade to organization. So Cliffwater Corporate Lending, that is a private lending strategy. So basically, as for example, McDonald's goes out and says, we need to raise money, we're going to issue debt, and you can buy this and we'll pay you 4% interest. Private companies also need capital. So this is basically just lending to private companies. But they actually had a firm, a large private equity firm, come in and acquire a minority interest in the organization. So still a minority interest. Cliffwater still has all the kind of operating powers. They are going to manage and control how they invest the portfolios. But anytime there are changes like that, we like to bring that forward to the group, just because, again, it's something that is different. If it was a majority stake in the company, where now Cliffwater is actually managing the money, doesn't have as much say, might be a bigger concern, but just something that we want to bring forward to the group and make note of. And then 2 white boxes that you'll see as you move towards the right, one for Tortoise Energy under people, one for the Principal U.S. Property Fund under asset base. Those are white, so those were previously minor concerns, or yellow. Those have been upgraded to no concern. So those are good positive kind of changes. And those would then be next quarter reflected as a green mark, indicating no concern. So again, those are positive changes overall across the portfolio. And then again, I think from a transparency standpoint, if you look at those columns on the right, we like to show what you're paying for these strategies. Expense ratio, that's the third column from the right. So you can see up and down, what you are paying for some of these. If you get towards the bottom, you see some of these fees being a little bit higher, 1% or even greater. Those are all going to be within some of those alternative or private market investments, which is very typical. But just to compare, what does that look like compared to peers or median expense ratios? You can see that directly to the right. So we basically say, all right, at the very top, Dodge & Cox Stock Fund, that's an actively managed large cap value fund. How does that compare of an expense of basically 0.5% to other actively managed funds that are similar style? And that average comes in at about 0.84%. So again, lower than that median. So that's really what we're trying to monitor. We think in some cases it makes sense to pay a little bit more because you're getting a unique investment and it's gonna, offer a unique kind of, risk return profile for the portfolio. So again, that kind of highlights any recent updates, and you see the comments on the bottom of page 23 and page 24, which is to discuss some of the other kind of more historical, concerns or notes that we've made over the last several quarters. If there's no questions on the scorecard, again, we think it very clean overall scorecard, not a whole lot to discuss. Page 25 and page 26 and 7 go through the in-depth kind of performance of these individual strategies themselves. So a couple of kind of points that I'll highlight here. Wendy touched on the fact that US stocks underperformed international stocks in the quarter. You will see that very prevalent if you look, for example, at any of the large cap equity, mid cap, or small cap. Those kind of first three main bolded categories, and you look at the year-to-date performance. For the most part, you see negative numbers depending on the specific part of the market within the US. Just below that, in international markets, you see Thornburg International up about 10% in the quarter. So again, big difference compared to, for example, Harbor Capital Appreciation, which is a large cap growth manager, two or three line items above that was actually down 10%. So again, a pretty big divergence there between US and international markets, which is a pretty big reversal of really what we've seen in any recent times. So helpful to have that diversification. It's nice when it actually works, which it is right now. And then page 26, again, kind of similarly, you'll see more positive performance here as we get away from kind of US stocks, but emerging markets, more flat-ish compared to developed markets. And then as we move down, fixed income, when you mentioned was positive. So nice to see, pretty strong quarterly returns. So all of those two fixed income managers, I should say, up around 3%. So in aggregate, just under 3% between the two of them. Real estate, which has been certainly a challenging part of the portfolio in the last couple of years. Nice to see a slight positive return in the quarter. Longer term, you can see it's still been a nice performer going back to 2006. It's done about 6% per year. Has added some nice diversification. And then really some more of the what we'd call diversifiers. So hedge fund strategies with two of them. One of them is Goldman Sachs. That was up about 1% in the first quarter. Again, comparing that to US stocks, which were down, adding some nice diversification. And then if we move down to the last page there on page 27, the other primary hedge fund strategy that we have was up just over 1% for that same time frame, 1.11%. Again, adding a lot of diversification and protecting the portfolio quite a bit. Then lastly, Wendy did mention other real assets. We did add Brookfield. It is not reflected in this particular book just because this is through 3/31. It will be included in the second quarter table of returns, as that was not actually funded until the second quarter. But you do see, again, some really nice performance there out of midstream energy, which was up about 7%, versus capital real assets, which is more diversified. Real asset exposure up under 2%. And then private equity, we actually did not have the numbers, but that we do have that now. That was up 1.8% in the first quarter. So again, pretty nice performance. And then Cliffwater, which is that kind of private lending fund. So again, lending to private businesses up over 2% a quarter. So again, all in all, what does that mean? It means the portfolio is up, just over about 0.75% in the first quarter. And as Wendy mentioned, probably up another percent or even more since the end of the quarter. So any questions? Again, that's why we like diversification, because we don't know when certain parts of the market are going to do better than others. And we like to have a little bit of exposure to lots of different parts of the market. So.
Good news. Move out and grow.
It's the goal anyway.
Very good. Okay. I think that pretty well sums everything up. Move on. The old business. The COLA for the old tire plant. That's the crux of why you guys are here. Are you able to share the slides, Matt? Sure.
Yes.
It helps if John out there. Yeah.
Could I have the actuarial folks? Do they do have anything to do with old air lease pension? Conducting the actuarials for that plan?
Technically, yes, GRS does do that work through FPPA. We do not directly work on it. And so I know sort of, brings up sort of a weird situation where like, you know, GRS is signing these reports, but we really can't talk about them because FPPA really prefers that questions be routed through, FPPA and through their folks there. So, very general comments, or very general questions we can talk about, but, in terms of the details, we probably can't offer quite as much as you would like for us to offer.
Okay. Well, that kind of answered my question. I don't remember, having seen an actuarial regarding that plan for the last one I have in my files from 2017, so I think we're a little behind on that. So I don't know what it would take to get a copy of that, the last actuarial.
I think what we can do is, so Dana back in our office, she's our point person for the FPPA. So I can have her, see if she can drop them a line and get you those reports are done every single year. So don't think that they haven't been done since 2017, but they've been done every year. So we can see about getting you a copy, if we can do anything in that regard.
Okay, that'd be great.
I think the city,
Goodness.
the city has those. We can send copies to the
Okay.
I'm sorry?
Well, the city has those. We are having
Okay.
those as well.
Well, I mean, I've been asking for it for a while and I haven't gotten it, so. That's what I'm trying to get to. Who do I need to talk to get it?
I think the people are in the room here. Do we have your contact? Email us, email? Do you want to put that on to us? Okay.
Mhm.
We'll get that out to you
I
today.
don't know why it's.
We've got it.
So that would be.
If there are any issues, will you let us know, Kevin, and we
Sure.
can contact Dana and
So that would be the first thing that's on my mind. It's just, because I'm not a financial person in this stuff. I mean, I stayed with you for about 10 minutes and then I was just like gone. So I need somebody to sit down with what building blocks for me and say, this is what this number means. This is where this number came from. Yada, 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 because, I just have a lot of questions, so I won't belabor that point more today. So that was the first thing. And then there's an issue, Monica, that you said we were gonna talk about today. And that was, a request to get the list of retirees. So have we
Yes.
resolved that?
The CAO is determining whether or not we can release that information to the board. I mean, names, yes, but not date of births.
Well,
That's the
I don't really
question.
care about, I mean, I can look at that date of birth. We would like to be able to contact the retirees before we sit down and say, you know, here's what we think is a fair and equitable request for a cost of living adjustment. I don't know what that means to somebody who retired 15 years ago or 30 years ago. Because there are some people in this plan that are making under $1,000, they're getting under $1,000 a month. And some people are getting 3 times that. So 2%, 4% for somebody who's getting $1,000 a month out of the plan. It's meaningless, really. I mean, maybe not to them, but it would be to me. So that's that's what we want the information for. We just want to be able to contact the existing retirees or their surviving spouses and get an idea from them what they would like to see as beginning point to negotiate with the city in terms of it. So that's all I want.
And
I
I
don't
think,
care about their dates of birth necessarily.
okay, well, in your request, it said date of birth, so that was a questionable.
Okay,
But I think Kevin is going to talk about the percentages that we asked for in the study and what that looks like, to answer your first question.
okay.
So we'll have an example for you right here.
Yeah. So we'll address that.
Discussion. Okay, see what, before we get to the step of going to council and asking for an actual amendment.
Okay,
Right.
So,
So I thought it best that the board make that decision rather than me just sending you a list or me
Right.
just sending you the study.
okay.
I do have a question, because of the presentation with the actuarial today. Were the old higher pension boards, were there actuarial payments made on behalf of them? Or when that board got shut down, are you gonna be showing us that
I'm
information?
not gonna go into that depth, but I can answer that. Yes, the city makes contributions every year to both of those plans of roughly 400,000 to each plan. So we're continuing to contribute to maintain our actuarial standing.
Okay. All right, thank you.
So what we would be talking about today is if we increase that, what would be the impact? So.
Okay.
And I think lastly is a concern, George and I talked about this a little bit last night. I'm not sure if there's much that can be done about it, but I think we both feel that this has been a somewhat of a long, drawn out process just to get to this point. And, for some of the people in our plan, they're old. I'm old. I'm not as old as some of say are, some of them, but, so the longer this drags out, I guess I'd like to figure out what's the best way, quickest way to move forward without waiting another 3 months to have another pension board meeting. And it seems like we're moving at a snail's pace, to be honest with you. So maybe there isn't a clear answer to that, but I guess my question is, what's the next step? Do we request to be put on the council's agenda to make a proposal for them, or how do we proceed with this?
Yeah, and we'll talk a little bit about that if I go through these slides. Well, I think what you want to do today is, and to keep this on track, decide in general if what you want to ask for from council. And we've got 2 examples. We asked for 2 examples from the actuaries from a 2% and a 4% increase. Let's look at a little bit of the impact of that. And then we can go back and get some more exact numbers and then get something on the council's agenda. And you can request that and see where it goes. Because we're right in the middle of our 26 budget process now. So it's good timing for that.
Okay. So what I'm hearing you say, Kevin, we'll go through this, but it looks like we may be able to get something in the 2026 budget to address the concerns that Steve is, George, you're bringing up.
I think that would be the hope, is that we can do it.
Yeah.
And
So is there,
over the next couple of months, we'll be talking about the budget.
And that's what we're trying to do here.
so there is no hope to get something this year?
That would be up to council. They could implement it in the middle of the year.
Okay.
Can I ask how many members there are?
I don't have they're roughly 30 in each. One's about 30 and one's about 35.
That's what I understand. They're right close.
Yeah, they're very similar as far as number of members. And contributions that the city puts in.
Let's see what we get.
So we did ask for a study on the old hire police plan, and since they're both similar, we didn't ask for the fire separately, but because there is a fee to do it and it's charged to the plan, so we thought we would start here and then we'll get more exact numbers if the board gives that direction. So we got that. It is from GRS, but not from the folks in the room, as you know. But we asked for a 2% and a 4%. The year one, contribution is the same, whether it's a 2 or 4% increase. But then you see there that, that second bullet, it's about 50,000 for each plan. But the second bullet is where the additional costs come in. It increases the accrued liability. 2% increases at 120,000 for each of the plans, and a 4% increases at 235,000 for the plans. And maybe the GRS folks can talk in generalities, but that plays into the future year contributions, right? Yeah. So even though the first year is 50, that addition, a 4%, which is almost double the additional liability, is going to come into play into year 2 for in perpetuity if we put these in as a COLA. That's the rough numbers. Now, the Innovest folks were kind enough to put us in touch with the city of Boulder. They do something a little bit different. They pay their old hire members a stipend. It's outside of the FPPA plan, so it doesn't necessarily impact that liability number that we saw on the previous slide. It's more of a monthly payment. We already have a monthly payment for retired people who are, and this would work just the same. You'd get a 1099, but it wouldn't be part of the FPPA contributions. And that would be some sort of set amount. It could be a percent of what they're earning now. It could be a flat dollar rate. That should be something to discuss if they want, if they like this option better than the going through the FPPA for. Still needs approval by city council. It's not a pension payment, so it's a 1099 for your taxable impact. That's going to be, for individual, is going to be different impact. And there's some administrative cost doing this, since we're doing it and the FPPA is not. This would be from the city and not from FPPA, these payments.
So will it require city approval, city council approval every year? Or just one time?
Everything requires city council approval every year.
And what if they get to a point where they decide not to approve it anymore, just goes away?
Yeah. We can only budget 1 year at a time.
What do you think the probabilities of that are? I mean,
Well, maybe.
This, I will tell you what my opinion is. These men have served this city and gave their life and put their lives on the line for us. And I believe the city is responsible to take care of them. And I can't guarantee what council's gonna do, but as long as I'm on council, I will fight for it every year.
and I think that would be the thinking of every council member. And coming, as long as I've been an employee here, the council and the city management has overall looked out for the employees. That's why this pension board exists, to oversee and to make sure that our pensions continue to be funded and meet their obligation.
So,
And the one good thing that I see in this thing, as I understand it, and Kevin, tell me if I'm wrong, is that it doesn't jump the city's obligation up in subsequent years. It keeps it the same every year.
It would be separate from the calculation that
Yeah.
GRS does, that tells us how much to contribute
Yeah.
to FPPA.
And that, to me, I don't know if we could write that into the thing, but that should be noted, that this is actually saving the city money and should be continued in every budget. And I don't think there would be a thing to cut it out. I just don't see it. at all.
And I mean, I suppose it could be written by the attorney to make sure it happens and comes forward. I don't know how that works. Even though there are disadvantages to this, I think the city's liability would be less than increasing the liability
Yeah.
through going through FPPA.
Yep.
And I'm sure that's why Boulder as well.
And a percentage increase perpetuates itself, so a 2% increase. The financial people there know what I'm talking about, so this being a solid number, essentially, it wouldn't increase everything. So let's say it's $300 per participant or whatever, it stays that, doesn't increase by a certain percentage, again, on top compounding every year.
That's the basic idea. I mean, you can request whatever you want. But
Well,
every 5 years to review it and do an increase
Right.
or something like that.
I mean, what's the possibility of maybe George and you and I sitting down and going over the actuarials? And we can throw some numbers back and forth with one another, because I don't understand where you're getting the previous numbers of almost $250,000. I'm just, that's mind boggling to me.
Yeah,
Maybe we can do that.
yeah, and we might need to go through FPPA for that. That sounds like what I heard is, yeah. Well,
Yeah, that's fine.
I mean, we could certainly have a basic discussion,
Sure.
but
Yeah, if you guys have the basic discussion, then maybe that clarifies it. Because I was talking to Gary Collector before the meeting. And his basic, act was, I would really like to stay away from FPVA. And, to do this, but I can see pros and cons on both sides.
Yeah.
So I would say that the way to go would be to have you and Kevin get together. And then if you want to pursue that, then you will have to go to the FPBA and go through GRS's.
Well, the first positive in 20 years is that someone actually gave thought and consideration.
Yeah.
I've been on the board for 23 years, and it was always, this is not in a contract. We're behind on the actuarial. This is a bad year. And it only made sense that the actuarials would always be negative. You had people retiring. That's one less person paying in, one person drawing out. You can go through 6th grade math and figure that out. Eventually, you're going to run out of money. But no one ever took it serious. And like it pointed out, did you, in your contract, when you were hired by the city, did they state that they would give you a yearly raise? No. But you assumed that somewhere you would get one. We're no different. For 20 years, I'm getting the same check every month. And at my age, I'm still working 30 hours a week. And it's not that it's bad or anything like that. I made do. Steve has made do. But there are people, like Steve said, who are way down on the totem pole, who didn't have rank like we did, that are making, I don't know how they get by, period. I really don't. And it's a shame, that's all.
I think there's a benefit too, is that I think you could be creative if you did it outside of the straight percentage. Where, a 2% for someone making $1,000 a month is
Like
$20.
Steve says, is nothing.
But you could say, well, at the minimum, we want to raise that to 1,300 or 1,400, but then you don't have to have that follow through with every single person. You could be creative on how that is calculated.
And that's why I think it would be better to start out with you and Kevin and keep it within the city here. And then sort it out, because you've got a lot of things that are available to you. And I think Kevin would have the expertise to help you a bit.
My one question though is, does this board have to vote on this before it could go to city council?
Well, even if it does, I would submit that we could do it by email or by, some sort of, if we had to call a meeting to do it.
I think that other boards have done that in the past. I don't know if that's changed because
Yeah,
change things, but
we'd probably have to get some approval, but you know, the main thing is to get this in the hopper and advance as fast as we can do it. And as chairman, I will take any, steps to make sure that that happens. And, no matter what.
And timing is a consideration, because the
Yeah.
26 budget is
Yeah.
happening right.
Yeah, and since we're in the budget process, it's always ongoing, but let's get it in. Let's get this, get the preliminaries out of the way as much as we can. You can always communicate with Monica and she can communicate with me or whatever. And if you need help, you know, I'm more than willing to step into this. And if it takes us to advance this, then that's what we'll do, Rita.
and I will do whatever I can. to
Exactly.
help as well.
All right, thanks. All right, Kevin, I'll be in touch with you.
Okay.
We'll work out a time to get together.
Absolutely.
Go with that, Jordan?
Pardon me?
You go with that?
Yeah.
Okay.
Okay,
So you don't need the other slide? Okay.
other business, anybody need to vent or bring or whatever? And, let's call this meeting adjourned.
Wait.
Some
Monica?
So we have retirement approvals and notifications.
Oh. I missed that. I went right to board members report.
So as far as, notifications, we had Tom Rio enter the drop. And then Rodney Roush, started his contributions, his distributions. We do have a death with the fire, the Old Hire Fire. I don't know if we have anybody here to represent them, but I guess the whole board now represents Paul Jameson.
Really?
Yes. So according to FPPA, that has to be approved by the board for his widow to receive his benefits. So that's something we probably need to vote on.
So we need to vote on that tonight.
Yeah.
Yeah. And according to the plan, as if I'm understanding it correctly, she would receive half of what he was receiving.
I move to approve it.
I second.
Yeah. All in favor?
Aye.
Thank you very much.
And
Okay. Now we're at board members' choice. Venting or questions.
next meeting will be August 12th. And I will be here and, we can go from there. And with the stipulation that if you need stuff before that, we will
We
advance.
do a special meeting.
Yes.
We may have to, that's up, I'm not sure how we would do that. If we needed a special meeting, we could do it.
And we can do it virtually.
Yeah, we can
Yeah,
do it
so-
virtually
yeah.
or, you know, whatever it takes.
Yeah.
We'll get a ruling on that. But I don't want this drug out for another year. We can get it in years. This next year's budget.
Okay.
Okay? Now the meetings are.
Kevin, what's your phone number?
Thank you. Seeing you at meeting. But I can do a pain in yourself.
You've gone through a lot, so there's leave some states.
Yeah.
And like
And these goes out in
That's right. Sounds good. Yeah.
So. And somewhere get something there first out of the way. But you know, somebody else, I don't remember, I was on the beach. She was thrown out on the sea. Yeah. I can-
Thanks for seeing you.
Where that.
Yeah, good to see you.
Only increase.
Right.
See you, Monica.
Yeah, thanks for like it's great.
And ostensibly it was to be applying to. But you, right. Well, the city, they're smart enough. So somebody else.
London, you were. Oh my gosh. Oh, how fun.
Sell it. There's ways.
Yeah.
I think there are others. You're not gonna be.
Yeah, it's not that, it's that difficult. I mean, you just don't realize how it is.
Right.
Yeah.
I think that's what I said. To not add to the expectation of response.
But I made it.
Right.
And that's all,
Yeah.
you know,
Exactly.
they're not gonna come up with the same way they want. I don't really know how to make, but, well, you know, everybody's in a little bit.
So George,
I
you need it?
actually have been very fortunate in my life.
And you know what? Let me write myself
I don't
on there.
need to keep the money.
Have a good one.
Yeah.
See you next time.
But that's different.
I forgot to stop the recording.
Majority of $1,000 a month, I was just.
We all do.
So.
Considering the Jerry County now.
We are, and I thought it was going to come up, but it
So you
didn't.
live over by
Oh,
Gary.
thanks a lot.
Yeah.
That's what he said, but.
I thought GRS was on it.
Oh.
So.
Christie and I
Thank
talked
you.
about it.
That's the problem. If you make it out of reach.
You take care. And
All right,
you know,
my
because-
benefits are roughly 3,300 a month, so
you
if we
can-
make
Let me,
2%.
let me get out of here.
It's a lot more money than it does to somebody who's making 1,000.
because I gotta stop the recording.
Thank you very much for everything.
Appreciate that, you bet.
I give you, do you have my business card and
Stop.
phone number?
No, I can't, it won't let me in my meeting.
If you need anything.
Okay, cool. Okay.
Yeah, it recorded, but now I can't stop it from recording. There we go.
I think we'll get it done.
Okay. I could.
And, so call me or call Monica if we're running into some things that these guys should, it's gotta come from another.
Right. Exactly.